All right, so part B in chapter 15, uncertainty in lease transactions. Sometimes you can have these provisions that at the time of the inception of the agreement, the lease agreement, it's uncertain what the outcome will be. So we want to look at those things. Kind of the general rule here is that if you have uncertain terms, you don't do anything, you don't even consider them. You just consider the things that are certain in the lease terms. The only time you consider the uncertain terms are when it's reasonably certain that the exercise of whatever the uncertain part is on the part of usually the lessee, but usually the lessor has to have a part in this too. When it becomes reasonably certain that whatever the uncertain term is will be exercised. And so we'll look at what that means to be reasonably certain. And so some types of things that we're going to talk about are variable lease terms, variable lease payments, residual values, purchase options, and termination penalties. And I'll probably do this part B in, I don't know, at least 2 parts, maybe 3, because it's kind of a long section. Forgot to get water before I started this. So please hold. All right. So right off the bat, just to give you an indication of what this means, reasonably certain and so in the book, once something becomes reasonably certain that the lessee will exercise whatever the option is, then the company has to adjust the lease term for the option. And so you look at the outlying or surrounding relevant economic factors to determine if something is reasonably certain. And so basically, if the benefits of exercising an option is high enough that the lessee is probably going to more likely to exercise it, then we have to adjust the contractual terms by adding or subtracting any either period of renewal usually is what's going on, or subtracting whatever amount or time if it's a termination clause. All right, so having said that, let's look at this example here. Wright Dental Services leased kitchen equipment under a 5-year lease with an option to renew for 3 years at the end of the 5 years and an option to renew for an additional 3 years at the end of the 8 years. The first 3-year renewal option can be exercised for 1/2 the original and usual rate. Well, that's a pretty good deal. And so the question is, what is the length of the lease term that Wright should assume in recording the transaction related to the lease? Well, I mean, the fact that the first 3-year renewal increasing to 8 years at 1/2 the original and usual rate is such a good deal that it's reasonably certain that Wright Dental Services is going to exercise that, so they should just record this as an 8-year lease. The second 3-year lease, well, we don't know. So we just don't do anything with that second 3-year option. Now, circumstances can change that require a reassessment of how long the lease term will be. Now, this usually requires a what they call a triggering event, such as the lessee now has an incentive to exercise an option that either extends the lease or terminates it. And once you have this triggering event, the lease term is reassessed, but only when a significant event or change in circumstance indicates a change in the economic incentive that is going to either create an extension, if that's what the option is, or termination, if that's what the option is. And so we have an example here. Lessee has no significant economic incentive as of the beginning of a 6-year lease to exercise a 2-year extension option. However, by the end of the 3rd year, the lessee has made improvements to the asset, and the only way that they can recover the cost of the improvements is by extending the lease beyond the regular 6-year term. And so at that point, the end of the 3rd year, it's pretty obvious, reasonably certain, that the lessee is going to extend the 6-year lease to an 8-year lease to recover their cost of the improvements. And so at that point, the end of the 3rd year, they have to adjust and increase by 2 more years. So at the end of 3 years, you've got 5 years left of this lease agreement. Now, some important things involved here are the fact that you've got to increase some things. And so at the end of the 3rd year, the lessee's got to remeasure the lease liability, and it's going to be equal to the present value of the remaining 5 lease payments. Also, the present value is figured out based upon the discount rate at the time of the reassessment, not the discount rate that they used at the inception of the lease. So that's a pretty important concept there. And so as far as the entry you would make, here we assume that the present value of the 5 remaining lease payments is $400,000. The current balance of the lease liability is $250,000 before we remeasure, and so we just simply increase our right of use asset account by $150,000, the difference, and of course the offsetting credit is to lease payable. Now, another thing that can occur is you may have to consider reclassifying the lease. It may have been an operating lease because it didn't meet any of the 5 requirements for classifying something as a financing sales type lease. Well, if it's reasonably certain that this option is going to be exercised, then that may require that the lease classification be reconsidered. And so in our example, we had let's see. And so you have to apply the 5 criteria to determine whether or not any of those criteria are now met once it becomes reasonably certain that the option is going to be exercised, is the point. Now note here, the lessors are not permitted to reassess any initial determination of the lease or discount rate. So you may end up having the lessee classifying the lease as one thing, whereas the lessor is classifying it as something else. It's not always the mirror image of each other. Sometimes there's uncertainty as to the amount of lease payments. This could be an increase or decrease of that amount in some future, at some future date, depending on whether or not some specified event occurs. Now, examples may include contingencies regarding revenues. In other words, once lessees have reached a certain revenue level, they might pay more in rent. Might have to do with profitability, might have to do with asset usage. There may be other types of contingencies as well. And the example in the book has to do with GAAP, and they apparently have an agreement with some of their lessors in like shopping malls where if the Gap store reaches a certain revenue level, then rents might be increased. And so this kind of shares the risk and reward between the lessor and the lessee. And so the general rule concerning these uncertain lease payments is we don't do anything with them until things become certain. And so at the point they become certain, then at that point it just becomes an additional separate lease expense for the lessee, and an additional separate lease revenue for the lessor. Now there's two exceptions to that general rule. One of those is when the variable lease payments are in essence fixed payments, and so it's a disguised fixed payment, such as a fixed minimum increase. And the example they have in the book talks about a retail store's monthly lease payments will increase next year by the higher of $250 or 0.5% of monthly store revenue. Well, we don't know how much 0.5% of monthly store revenue is going to be, because that's going to occur in the future, but we do know that at least this store is going to have to pay $250 more. So we have to include that, because that is in substance a fixed payment. All right, so here's an example of an uncertain lease payment. Brighton Early Vineyard leased a truck for a 5-year period, at which time possession of the truck will revert back to the lessor. Annual lease payments are $11,000 due on December 31 of each year, calculated using a 4% discount rate. If Early's revenues exceed a specified amount during the lease term, Early will pay an additional $3,000 lease payment at the end of the lease. Early estimates a 70% probability of meeting the target revenue amount. What amount, if any, should be added to lease payments used to determine the right of use asset and lease liability as a result of the contingent rent agreement? Well, this is certainly not a situation where they're going to pay a dollar amount or a percentage of their revenue if it goes over a certain amount. Here it's kind of, the whole 70% probability kind of adds a new twist to it. But the 70% probability, although that's high, is not one of the exceptions. The exception, again, being it's in essence a fixed payment. In our previous example, the $250 or 0.5% of revenue, well, we at least have some certainty to that, in that that company's going to have to pay at least $250. Here, even though, and the other one is that it's tied to an index, and we don't have that going on here. So this whole 70% probability is kind of a distraction, I guess you might call it. It's irrelevant. And so the answer here is that what amount should be added? Well, 0. Sometimes the parties agree to modify the lease terms, and there's two possibilities here. First is that the modification might grant the lessee an additional right of use. In that case, what that means is that they're terminating the original lease, and they are creating basically a new arrangement as a new lease. Now, the second situation, this they're altering the lessee's right to use the asset rather than grant an additional right. In that case, this just means that they're adjusting the original agreement, and they're either adding to or deleting what's been recorded in order to conform to the new terms. It also means that they may have to reclassify from a finance sales type lease to an operating lease or vice versa. All right, so we have an example here, um, pretty detailed, but you've seen this example before. Sans serif leased printing equipment from First Lease Corp. First Lease Corp purchased the equipment from Compudec at a cost of $479,079. The lessee's borrowing rate is 10%. The lease agreement specifies 4 annual payments of $100,000 beginning January 1, 2021, the beginning of the lease, and at each December 31 from 2021 through 2023. The useful life of the equipment is estimated to be 6 years. The present value of those 4 payments at a discount rate of 10% is $348,685. On January 1, 2023, after 3 payments, the lessee and lessor agreed to extend the lease term by 2 years and increase the remaining payments from $100,000 to $130,000 each, and the market rate of interest at that time has decreased from 10% to 9%. And so the modification, just so you know, occurs 2 years in the lease, but there's been 3 payments. One payment made right up front at the time of the lease agreement, January 1, 2021. Another made December 31, 2021, and another December 31, 2022. So you've gone from the original lease being 4, again, the useful life is 6. You're now modifying it to where the lease term is for the whole useful life of the equipment. And so that's going to increase your present value. Payments are increased, so that increases your present value. The discount rate goes down, so that increases your present value. And so the present value on the original lease on January 1, 2023 is only $90,909 because you only have 1 payment left in the original lease. But once it's modified, you've got 3 payments left. So that increases your present value by the difference between 90909 and 329,068, or 238,159. It also changes, and so you have to make an adjustment to the books there. And then the other thing is, you have to reassess the type of lease this is. Well, it was an operating lease because you didn't meet any of the 5 requirements for a finance sales type lease. But now that you've met the requirements, the term is for the full useful life, and there may be some other requirements that are met as well, but it just has to meet one of those five in order to qualify as a finance sales type lease, and it does. For the lessor, so the lessee's got to increase the present value balances by 238,159. The lessor has to record this now as a sale of an asset, and they have to remove the asset's carrying amount, meaning removing the cost of the asset as well as any accumulated depreciation. And so that's what happens here. Sans serif increases the right of use asset account by 238,159, and of course lease payable is the credit. First lease, the lessor records the lease receivable and corresponding sales revenue for the present value of the 3 remaining lease payments. And then, of course, because this is a sale type lease, they're going to record the cost of goods sold less accumulated depreciation. They're going to have to back out the accumulated depreciation as well as the cost of the asset as well. All right, let's see, where are we? All right, we still got about 10 pages here, so I'm going to stop there and pick it back up here.